Hi guys, welcome to weekly mentoring video. It's Adam speaking, Option Mindful. It's Monday 31st 2021, broadcasting from Quito, Ecuador. Today we'll have very interesting program, very special, much shorter than usual, but maybe more focused on content. I will not go too much into analysis of what's going on the markets. We'll focus on the portfolio and a couple of trades. Finally, something happened in that portfolio because markets have been just going on up and up and up and up. But one of the positions that we discussed 2 weeks ago has moved a wrong direction and we need to manage it. So finally something to do, and also I want to do some new trades with my students, so will be a cool video. Today markets are actually closed, so the trades that we will place will be just sitting and pending, but that's not important. We're trading anyway on paper. So having said that, remember that this video is for informational educational purposes only. My views and perspective are my own. I'm not giving any advice to you. So if you agree with that, let's continue and see what the program is going to be about. So part one will be about Exxon Mobile. So we have losses, and what now? We're about 1.5k losses generated by this position with the current position in the portfolio, because overall on Exxon Mobile we're actually making that money. But the current trade is losing, and I want to show you what to do now with this. We will talk about protective call right in here, and part two will be for my students from Option Mindful Academy. We'll analyze, manage the portfolio, plus we'll do a trade on semiconductor space, and it's on the company called ON Semiconductors. This one. So I will show you how I can approach this. We'll do some technical analysis, we'll look at options and so on, and decide which kind of trade would be best, which kind of trade strategy would be best. Should we wait? Should we place the trade now? And if we do, what kind of strategy we're gonna use for that. So having said that, I'm just gonna quickly switch to Thinkorswim, and you can see first of all that our portfolio is doing very well. We don't have too much currency now for buying options. That's because the portfolio is kind of like full of many positions, mostly in the mining space, gold and silver, but we have also some speculative positions. We have some this medicine, so mine medicine position, which we entered some time ago. We have oil, we have silver, we have speculation on AT&T, Exxon Mobile, Walmart. Some of the positions are doing good, some of them less, but in the end, if we look at the overall PL year to date, we are at 50k right now. Year to date performance, that's really cool for this portfolio. We started with around 130k this year. So it's very nice return. We're like at the end of May, and we're cash flowing $426 currently. That's the theta column per day. Unfortunately, I cannot see the delta, but I can assure you that it's very bullish because the markets are bullish. We have also some insurance here in the portfolio. This is the position that is losing most. Of course, we're paying for the insurance, right? So you see very negative delta here, okay? The beta weighted delta. So basically, if you add all these deltas, you can see that on some positions we're very bullish, and this is the only bearish position which protects us from the downfall, but it's not too much of it. Yeah, I would probably add a little bit more to this insurance if I see that the market shows like some big weakness, and we need to protect the portfolio from the bigger losses if it starts to correct. At the moment it doesn't do that, so I don't see any signs of weakness at the moment. Market seems to be pumped. Fed is just pumping more currency into the economy. Companies buying their own shares, and I just don't see the reason to be over-insured right now. So that's it. So that's what we can see. Portfolio doing very good, very nice returns on investment, very nice performance. Let's just jump into the trade that we discussed 2 weeks ago, and that trade is Exxon Mobile. Okay, before I do that, I just want to show you a little bit trick that I do that like kind of every week to see which position need to be managed or I need to pay attention to, especially if you have a portfolio of this size. You simply go to the PL open column, so profit losses open, and then search for positions which are in a negative numbers. So this one, for example, has negative $150 here in it. I look at the ticker and I see, okay, it's in gold mining. I probably should take a look what's going on in there. Why is it losing? Another one here, 153 down on, what is it, Chevron. What's going on? You know, why am I losing here? DNN, Danshan Mines, uranium. What's going on? Why am I seeing negative number? I should probably pay attention to this. I ignore kind of losses like this, you know, $15, I don't care. Probably it's a fresh position. If I see some pain, you know, JackGF, no. It's a longer term speculative position. What is this, MOS? Not much, you know, to pay attention to. Scroll down. Silv, okay, something to do. That's my insurance, it's okay. I have a problem here on the side of AT&T. Something is not all right. I should probably check what's going on and you know, manage this position. And then scroll down, and I see that I have a problem with Exxon Mobile here. Okay, the Exxon Mobile is here. So this is something that you know, I put in the agenda for today. Let's discuss Exxon Mobile. What the hell happened? Why are we looking at 1.5k losses, and why didn't I close the position, or why didn't I manage it yet properly? I didn't manage it because I wanted to manage it with you and show you what I want to do with this. Okay, so what happened here? We acquired 1,000 shares of the company by selling a put, or 10 put contracts, which were assigned to us. So we now have them at $60 per share, and the current price of Exxon Mobile is at $58,370. So it went down. Okay, went down by almost 2 points. That's why we see this number here. Okay, so basically you can see by how much it went down. We lose $1,630 on it. This position is not just the stocks. Okay, this is the shares that we own. We also have other positions in there, and these are option contracts. First one is I sold 60 calls on it. They expire in 4 days, just to bring in some premium in case Exxon Mobile returns to 60s, you know, from this level. I would have to sell those stocks and collect my $430 premium, so I will be positive. If not, I'm just going to keep $430 premium and reduce the cost of ownership of this Exxon Mobile and reduce my loss. So that's why I did it. As soon as I saw that Exxon Mobile starts going down, okay, I kind of protected myself and sold this 60s at a little bit of a profit. And then I also sold, so I'm kind of bullish, you know, Exxon Mobile on bullish oil. So I sold also, this is a 57. Okay, you don't see that here, but it's a 57 put options, 10 contracts for another 1,000 shares. In case Exxon drops to $57 per share, I would like to collect another 1,000 shares. Why? Exxon Mobile pays really nice dividend, and I'm bullish oil. And however, I don't want to take all the losses. In case Exxon Mobile goes and drops to $50 per share, I would see really nice negative number here. It would be very painful to see like 9k here negative. So what can I do? I'm bullish long term, but short term looks like we are kind of losing. How can I protect myself? How can I protect myself from bigger losses with this position? Let's look at it first of all from two more perspectives. Let's look at it from the chart perspective first, and then risk profile. So on the chart, how does Exxon Mobile look like? Okay, so let's have a look at this. So you see that it had this nice bullish run in here. Okay, then it kind of corrected from the levels of 62s and a half, more or less, back to 55s, kind of wiggled there, and then came back up to 64s, reached its old year-to-date highs, $64 per share, and then corrected again, kind of like this. On earnings there was this euphoria, and then we had some dividend paid out, and then it came back down to 58.37. Okay, so I see a couple things with this chart. I see a very solid support here at the level 55. Okay, I see that Exxon Mobile, okay, has a bullish trend, so 200-day moving average going up, 50-day moving average kind of going up, reversing sideways move, like basically just straight line. And we have a little bit reversal here on the 20-day moving average, so it kind of became bearish again. I expect that it's gonna bounce here of this level. It come back up to the levels of 62.5, 65, somewhere there, and just continue going, or just stays in this channel for a while. Okay, we will see. But generally I'm bullish, And I see that the company makes money. First of all, they beat their expectations here. Plus, they pay very nice dividend, 87 cents per share. Okay, so if I have 1,000 shares, that's basically $870 every quarter. Okay, so in a year, what does it come to? So let's calculate this. Calculator, just so you see, if I'm getting 870 per quarter, so I multiply this 4 times, okay, $3,480 in dividends per year. Okay, if I own 1,000 shares of Exxon Mobile, if I own 2,000, then that's double that. So it's a nice dividend payer in a sector which is quite strong right now. Oil going up in price. There have been some problems in the oil industry, basically like war zone somewhere in Israel zone, somewhere there. Pipe problems in the US. There are some cyber attacks. So looks like oil is getting some attention, and also we have rising prices, we have inflation going on, more currency printing. Where else to hide inflation rather than high energy prices? High energy prices, high oil prices. You need to justify the price of oil, of course, why it's so expensive. Maybe by some problems with pipes, maybe by some conflicts in the Middle East. I don't know. And if you raise the prices of oil, then of course you can justify the rising prices in food and or other areas, right? So I'm really bullish oil because of these reasons. And however, you can see that short term this kind of moves sideways, and we are in some sort of a trouble. Yeah, we see the loss. What if this continues and goes down back to 55s? Well, that's not gonna be cool. But I'm still not gonna be worried too much as long as I'm gonna see that it bounces and comes back up. Okay, if it comes back up, then fantastic. I'm making money on the shares. I'm making money on the calls and puts that I sold. I'm gonna be very, very profitable on this trade. However, if this support zone at 55 gets broken and this continues going down, maybe to visit its level of 52.5 or 50s, I will be in serious trouble. I really see really negative prices, and I want to avoid big losses in this portfolio. So how can I do that? How can I protect myself? What should I do? What kind of strategy should I do? Should I sell the stocks already and just get out of the trade? And no, that's not my goal. Actually, I like Exxon Mobile. I want to have those shares. I want to reduce the cost of owning those shares, and I want to collect my dividends. So I'm okay owning Exxon unless it just goes down like crazy to really low levels here. So for now, I don't want to get out. I don't want to close that trade. But if it breaks the level of 55, maybe I do, because I don't want to. Maybe I want to wait until if it breaks this. I'm gonna wait until maybe it reaches some levels here, matches this 200-day moving averages and bounces like around level of 15, and get back into that trade again, avoiding the losses on the way. How can I do that? How can I protect myself? So there is lots of possibilities. I could be buying puts. I could be just shorting the stock, or basically buying the thing back and playing around with strategies like this, selling some calls and just hoping that this moves slowly down. I could be selling like vertical spreads on the put side to bring more premium. I could be doing lots of protection here, but I have one technique which I prefer mostly in case of when I own the stocks, when I own the shares of the company, and I accept certain level of support, and below that level I would like to be out. I would like to protect my profits, or basically my cap my losses to a certain level. So that strategy is called protective call right, and I'm going to explain to you how it works and what it does. So protective call right is simply writing an in-the-money call, so selling an in-the-money call to bring enough premium to basically break that trade even, or limit the losses to a certain level, up to also certain level. So how does this work? It works simply like this. I can basically create an order in Thinkorswim which is bringing me premium, and I can decide at which level that trade, that call should be, so execute it, and at which level strike price I would like to sell. It would be in the money call, and typically, in this case, I would like to trigger that call only if the price of Exxon Mobile drops below or touches the level of 55. So it's a trade that is going to be basically sitting out there and waiting to be filled in case that scenario happens. So in case this scenario happens, what am I going to do? I'm going to sell an in-the-money call at a level of 52.5. It could be also 50, but 52.5 is, I think, good for me. As I see, there is another level of support. And what I'm going to say is, if we reach level of 55, sell 52.5s to bring enough premium to limit my losses, to a certain level. And it's a call, so I own the shares. Remember, I own the shares. I own 1,000 shares of Exxon Mobile, so I'm positive here. And at this level, I'm gonna sell 10 call contracts in the money, okay? Saying that, if we drop below 55, I am willing to sell these shares at the level of 52, and for this, I'm going to collect a lot of premium, okay? Because I'm in the money. Yeah, so in the money means I will have a lot of extrinsic value in there, and that extrinsic value will cap my my losses to a certain level. I will show you how this works when we look at the Analyze tab in the risk profile. So that's basically it. We reach the level of 55, and at that time sell 52.5 calls to bring premium, okay, to pay premium to pay me for to cap my losses basically. If this thing gonna continue dropping then below 55, okay, and bounces, or sits then on the 52.5 and so on, well, great. If it goes, I'm not gonna lose too much anymore, because this brought me a premium back, and if the thing returns, start coming back up, well, then I will have to sell these shares, and basically, I take some losses, but I'm kind of protected. If this level is never reached, okay, that trade will never be executed. Okay, if level of 55 is never reached by Exxon Mobile shares prices, I will never execute this trade. So it's a protective strategy, protective call right strategy, and I show you how this works. So let's go to Analyze tab first and see Exxon Mobile. Okay, I already have a plan here for the protective call right. So that's our trade. Stocks are currently down by 1,630, and you know that I also have two option contracts here, one expiring in 4 days, that's the 60s. Okay, this one is probably going to expire worthless, so I'm going to collect $430 for this. And then the other one, which is another put contract here at the level 57, expires in 11 days. I don't know if I get the shares or not, probably not. Unless maybe really Exxon Mobile drops down to 55s. Yeah, but at the moment I just want to protect myself from the stocks dropping in more than 11 days to the level of 55. So just these shares. So I'm going to just look at the share perspective. Okay, so I'm in the losses now. I would like to, if the price of Exxon Mobile drops to 55 bucks per share, I'm going to be short by, I'm going to be short by 5,000K. So I'm going to be losing quite a lot of significant amount of currency. If it drops to 52.5, I'm going to be short like 7.5K. That's quite significant losses. If I go to 50, 10K down, that's not great. So how can I protect it? Okay, let's do this protective call right strategy on this. So what I said was I'm going to sell. I'm gonna go sometime in the future, like let's say July 16th, and I'm gonna say, if the price drops below 55, I want to sell 52.5 calls. These are currently trading at $6 for per share. So if I sell 1,000 of those, that's gonna bring 1,000 shares, so that, or 10 contracts, is going to bring $6,400. However, that would happen, that premium would be paid to me if I did that trade right now, with Exxon Mobile trading at 58.37. However, I said I want to sell a covered protective call only if the price drops to 55 or below. So how can I do this? I can use a fantastic tool which is provided by Thinkorswim, and I'm going to show you this right now. So I'm going to say sell 52.5s, and right now, if I would sell them, and to receive this kind of premium, the price is at around 58.37, but I'm interested in 55s, right? And this fantastic tool is exactly here, expected Exxon price. Okay, I can play with the premium here. I can say, you know what? What if I offered, to sell at 5? How low would the Exxon price have to be? Okay, I change that number here. Notice I put 5 here. They say that in order to receive $5 of premium for this 52.5 calls, the price of Exxon Mobile would have to drop to 56.63, okay, per share. Well, that's not exactly 55, right? So of course this is a simulated price, just expected price. It's not maybe what it's gonna be, but it's good enough for me. So in terms of estimate, okay, so it's pretty accurate. So I see already that 5s are not fulfilling my my requirement, because I said I wanted this trade to be executed only if the price drops below 55. Okay, so that's way too high. 56.63 is not the level that I'm interested in. So let's go lower. 4. Let's offer $4. That's 55.39. Very close. How about 380 or 390? Okay, that's 50. Okay, let's do 380, 50. Okay, how about 70? 370. That's around $55 per share. Okay, so that would be interesting to me. So if the price of Exxon Mobile drops to the level of $55 per share, this trade will be automatically executed and bring me $3,700 back to my portfolio, okay, of premium. Okay, if the price remains above that after this trade is executed, I will probably have to sell this shares for sure, this 1,000, and take my losses. If price drops further down, we run into another situation which I'm going to show you right now. So let's analyze this trade. I'm going to bring that in. So what you see here is just the analysis of owning 1,000 shares and then selling 10 contracts in case price of ExxonMobil drops to 55. So you see what it done to our trade. Basically, it capped our losses to $3,800. Okay, so I remove this quickly so you can see the difference. So right now we are currently losing $1,600 or something like this. If ExxonMobil goes and drops to $55 per share, I lose $5,000. If it drops to $50 per share, I lose $10,000. However, if I sell that protective call, as soon as the price of ExxonMobil drops to 55, then I'm capping my losses to this level, and that level is at $3,800. Okay, and then no matter what happens, if the Exxon decides to, after dropping to 55, then the trade is executed. If the Exxon decides to come back and basically reach $60 per share, it doesn't matter anymore. I'm still gonna be short $3,800 because I sold this call. Yeah. If, however, this level is never reached, okay, then this trade is never executed, and I'm gonna be in the trade like that. Okay. If it is, and it continues going down to 52.5, I'm always capped at the expiry, you see, to $3,800 of losses. If it continues going down further, I'm also protected. Even if it drops to the level of 50, I'm still losing just 6,500, okay, instead of 10,000, which was the case without that protective call. Okay, 10,000 compared to 6K is already much better. Why? Because I collected this premium here. Okay, so obviously I could be playing with this and go and change this maybe expiry date, and instead of expiring in July, I could be going to the 20th of August, and then I could probably reduce that losses a little bit more if I just extend that date to August and say, what, now I can increase this level of premium because the time value and so on added. So maybe I could be doing 4.2s, okay, even more, 4.3s, 4s or 4.3s, I think would be more accurate. Yes, 54.95. However, I would have to wait for this call to expire, you know, in more than 46 days, so 81 days. I don't know if I want to give it so much time, and the difference would be not so big, you know, in terms of the win that I'm gonna get. If the price of Exxon Mobile now drops to basically 55s, you know, I cap my gains at 3.2 and not 3.8. So yeah, very little difference for this size of portfolio, but much more time, and I don't think that makes any sense. So I would probably be happy with just having this 16 Julys and do the 3.7s, okay, and just execute that trade and make it good till cancelled. So this would be like a stop loss kind of trade. It's another version of stop loss. Let's bring that back to 16th of July, right? That's 16th of July, 40 something days, and I'm going to be doing 3.7s because I want to be at 55.2 more or less, or 55 in general. That's where the trade should be executed. If we never drop to that level, I'm not going to be selling these calls at all. Okay, so what else could I do? You know, could I execute this trade also at another level? Yeah, I could do this also at 57.5 or 57 or something. You know, and cap my gains earlier, or reduce my losses earlier, not wait until it drops to 55s. But I feel comfortable with this trade, and I don't think, you know, Exxon Mobile actually will go there and correct to 50s and then go back down to 0. I think it will come back. So I'm okay with this trade. Yeah. So the plan is now to protect this 1,000 shares, and in case Exxon drops to 57 put level and go down, I can be filled and assigned on this. So I'm going to protect only these ones, and these ones I'm going to be assigned, and then check, you know, recheck again in weeks later what's going on with Exxon. Is it continue dropping, or basically monitor this every day, and if it continues dropping, maybe change the strategy. But for now, with the current status of this portfolio, that's the strategy that I would use to protect myself. So let's just make this good to cancelled, and I'm gonna send this trade and confirm. You can see that if this gets executed, I'm gonna be credited 3,000, almost 700 bucks. Okay, and by this I'm going to be protecting myself until the level of 52.5. Okay, so in price of Exxon Mobile, which I think, you know, it's not very likely it's gonna get there, but you never know. So let's see. Send this, and this is going to be now added to my pending orders here, and just going to wait until you know, execute it. So I'll be, of course, monitoring Exxon Mobile now and seeing what's going on. I really hope that it's going to come back and, you know, be maybe more profitable to us, or just stay for the next 4 days a little bit below 60, so I can sell more 60 calls on it. You know, but if it doesn't, all right, then we already have some sort of a plan to protect ourselves. It's a very nice technique, especially on you know, on companies which stocks you own. So if you own some stocks of a company and you don't want to sell them, that could be a very efficient strategy, just sell them in case of an emergency. But if you don't reach that price level here, which is now very nicely illustrated here on Thinkorswim, you see that I have my order around at this level, 55s, right? So it will be only executed if Exxon keeps dropping and goes below this line. Then I'm executed, and, you know, I'm going to offer to sell 1,000 shares at 52.5. Okay, and obviously if this goes down and kind of bounces here and starts coming back up, I could be buying back that contract which I sold, collect some additional premium out of this, and expect that Exxon is going to return, yeah, so to its previous price levels. Let's see, however, what's gonna happen. So the plan is here, executed, waiting, you know, unprotected. I feel like this position is managed now. I don't have to pay too much attention to it. Only after this is executed, I may be you know, paying more attention, and also if I get assigned this 57s at some point of time, I may also start paying a little bit more attention. I don't want to have too big losses on this portfolio. Okay, so in general, like I said, I'm bullish oil, and I'm gonna remain being bullish until whatever some otherwise said, you know, until something changes in the economy. So That's it for you guys from YouTubers. That's the update. Now I'm gonna go and talk to my students.